Each year, millions of taxpayers file a 1040 to let the IRS know how much they made throughout the year. And each year, millions of taxpayers sign that tax return and they don't understand what the tax return is saying. Is it you? Are you one of those taxpayers? What I've discovered year after year is that taxpayers file taxes because they have to. It's an obligation. And because they don't want to be in trouble with the IRS, they sign that tax return stating everything on there is true, even if they don't know what it means. I believe that every taxpayer has the right to understand what is on their tax return. And that's why I created this presentation. I have 15 tax terms that I believe every taxpayer should know. It doesn't matter if this is your first year filing or if this is your 40th return you filed. These 15 terms are going to be relevant to you, even if you don't have a business or anything special on your tax return. So let's get right to it. Before I go too far, I do want to go ahead and introduce myself. My name is Timalyn Bowens, and I am America's favorite EA. As an enrolled agent, I'm licensed through the Internal Revenue Service to not only do tax preparation, planning, and advising, but the part I love the most is representing taxpayers. I step in my client's shoes and handle their IRS issues for them. I'm also the owner of Bowens Tax Solutions. We are a virtual firm based in Louisville, Kentucky that specializes in resolving taxpayers' issues. And you know what? I would say 8 times out of 10, these issues arise from a misunderstanding, not anything that was intentionally done. Another reason why I'm passionate about educating taxpayers on what their tax obligations are to help prevent them from being in tax trouble in the future. I'm also a wife and a mom before anything else. And that is why this is so near and dear to my heart. I see tax issues affect families just like mine because they don't understand. So without any further delays or distractions, let's get right into these 15 tax terms that I believe every taxpayer should know. Number 1, Form 1040, also known as the tax return. Now, the reason I'm starting right here is because I often hear taxpayers use tax refund and tax return interchangeably, and they're quite different. Form 1040 is the form that individuals use to report their income throughout the years to the IRS. As of right now, it is 2 pages, and then there are additional schedules to back up what's shown on the 1040. But the 1040 gives a summary of all of your financial activity for the year to be reported to the IRS. So number 2, we have our gross income. Gross income, let's go back there. Number 2, our gross income is going to be things like wages earned, any type of business income, dividend income, interest income. It's your income before any type of deductions are applied. I want to note here, because often I see people get confused by this too. Gross income is not what you are taxed on. Gross income is just the starting point. Number 3, we have tax deduction. Now, tax deductions are often confused with tax credits. A tax deduction is going to lower the amount that you are taxed on. So as I mentioned before, your gross income is not what you were taxed on. Once deductions are applied, it lowers the amount you're taxed on. For example, let's say that your gross income is $100,000. After applying the 2021 standard deduction for married couples filing jointly, which will be $25,100, you are not going to be taxed on your $100,000 that you earned. Instead, you're going to be taxed on $74,900 because that tax deduction lowered the amount that you're being taxed on. All right, number 4, adjusted gross income, which is also known as AGI. Your adjusted gross income is the income after all adjustments. Adjustments are similar to deductions have been applied. It's very important that you understand this number because your AGI, or adjusted gross income, is what lenders look at to see what your ability to pay is. For an example, if you go to apply for a mortgage, yes, the mortgage company and lenders, they want to see your tax return, but the main number they're looking at is your AGI, your adjusted gross income. If you have student loans and you are in a income-based repayment plan, what they look at is your AGI to figure out how much you can reasonably afford to pay. Next, number 5, we have the standard deduction. Now, as I mentioned before, next tax season, the 2021 standard deduction for married couples filing jointly is going to be $25,100. The standard deduction is different for each filing status. So it's different for single, it's different for head of household or qualifying widower. It's different for married filing jointly or married filing separately. The standard deduction is a fixed amount that the IRS allows taxpayers to deduct from their income before figuring their taxable income. Now, each year, the standard deduction goes up a little bit to account for inflation, but I will warn you, it doesn't quite keep up with the rate of inflation, but it's a good thought in theory. Number 6, itemized tax deduction. Now, I usually hear business owners say, oh yeah, itemized, but in reality, they don't. They list all of their business expenses, which go on a completely different form called Schedule C. When you hear a tax professional refer to itemized deductions, this is for taxpayers who typically own a home. They typically give to charities throughout the year, and they pay a lot in state, local real estate taxes. Now, the difference between the standard deduction and the itemized deduction, remember the standard deduction is going to be a fixed amount that the IRS allows. The itemized deduction is allowed to go over the amount of the standard deduction. And if that's the case for you, along with myself, I'm sure other tax professionals would encourage you to use the itemized tax deduction. An example of an itemized deduction is going to be medical expenses. Those are limited based on your AGI, but also state and local taxes, property taxes, your real estate taxes, mortgage interest paid throughout the year. If you are a churchgoer, money that you've given to your church. Now, for cash donations, it's going to be very important that you have a statement from that organization saying that you did not benefit anything tangible that is, from the donation that you gave. So for example, if you went to a charity ball, but you also received a dinner in exchange for the purchase of a ticket, the amount of the dinner is going to be subtracted from that. So that is an example of an itemized tax deduction. Number 7, taxable income. So remember, as I stated earlier, your gross income, what you bring home on your check, isn't actually the amount that your taxes are based on. It's the foundation, but it's not where we end. Once we have your gross income and we factored in all adjustments to bring that income down, and then we apply the standard deduction or itemized deductions, whichever you qualify for, then we get your taxable income. Your taxable income is what's going to be used to apply the different tax rates to figure out what your tax liability is going to be for the year. This is your taxable income, the amount that's actually taxed by the IRS. Number 8, we have tax liability. This too is a term that I often hear confused by taxpayers. They believe that if they get a refund, that means they did not have a tax liability. And well, that's just not true. If you make more money than the amount of the standard deduction that qualifies for you, so let's say in 2020, the standard deduction for a single taxpayer was $12,400. If said taxpayer made more than $12,400, they absolutely had a tax liability. Now, just because you have a tax liability doesn't necessarily mean that you're going to owe the IRS at the end of the year. That's because we have a progressive pay-as-you-go tax system, which means if you work for somebody, as an employer and you get a W-2, throughout the year, they are withholding tax payments on your behalf and paying them to the IRS. And this is what keeps you from actually owing at the end of the year. So again, your tax liability is the amount in taxes that you are obligated to pay based on your taxable income. Next, number 9, we have a tax credit. Excuse me. Tax credits are often confused with tax deductions, and I hear them used interchangeably. But I would say about 9 times out of 10, a tax deduction is actually going to be better than a tax deduction. A tax credit reduces your tax liability dollar for dollar. So the IRS looks at payments as a credit toward your tax liability. Also, we have things like the child tax credit and additional child tax credit. Once you have a tax liability, let's say, for example, of $2,000, and you have a child on your tax return. In previous years, prior to next year, which will be the 2021 filing season, the child tax credit was $2,000. So if you have a tax liability of $2,000, your child tax credit dollar for dollar canceled that out and allowed you to get back whatever you had paid in throughout the year. Now, there are 2 types of tax credits. We have the non-refundable tax credit that we're about to talk about now, and then the refundable tax credit that we're going to talk about next. So number 10, non-refundable tax credit. A non-refundable tax credit is limited to the amount of the tax liability that you had. So for example, let's use the same one that we had before, but this time, instead of a $2,000 tax liability, you have a $1,500 tax liability. The child tax credit, because it's non-refundable, is going to be limited to that $1,500. It can only be used up to the point where it zeroes out your liability completely. So you have a $1,500 tax liability, a $2,000 tax credit. That tax credit is then reduced by $500 to $1,500. But the beauty of the child tax credit is that if you can't use all of it, it turns into the additional child tax credit. And again, this is going to be changed for next tax season, but just to give you an example, because we could not use the full $2,000 because the child tax credit was non-refundable, it transitions to the additional child tax credit. So even though you may not have any more of a tax liability left, what the IRS says with refundable tax credits is that you can receive that back in the form of a refund, dollar for dollar. So we have a $1,500 tax liability. We have the $2,000 additional child tax credit reduced to $1,500. Now the $500 that was left is going to be refundable as the additional child tax credit. Number 12, we have tax payments. Now, for my self-employed individuals, you should be making quarterly estimated tax payments. For my people that are not business owners, if you work a W-2 job, you're making tax payments through your employer. Once we figure your tax liability and we've applied different credits, then we apply any payments that you've made throughout the year. So in the examples that I used before, if we had the child tax credit to zero out your whole tax liability, any type of payments that you made throughout the year, you're going to receive in the form of a refund. If you did not have credits that canceled that out, we would apply the payments. And once the payments are applied, if everything is covered and you have anything remaining, you get that back in the form of a refund. If you are short in your payments, then you have an amount due. But first, if you look at the 1040, page 2, it looks to see whether you have a tax refund first. A tax refund is not a tax return. You have to file a tax return, but a tax refund is if you have an overpayment on your taxes. Now, remember, just because you get a tax refund does not mean you didn't have a tax liability. Just because you have a tax liability does not mean that you may not potentially get a tax refund. If you have enough credits to cancel out all of your tax liability, anything that you paid in throughout the year, you will get back in the form of a refund. If you have enough non-refundable tax credits to cancel out your liability, and then you're also eligible for refundable tax credits, you will get that back in the form of a tax refund. Now, everybody's situation is not the same. Sometimes you didn't have enough withheld, or you messed up on your quarterly estimated payments. You may not have even made any. This ends up being the amount that you owe. Pretty straightforward, right? Well, there's something else I want to note here. If you have an amount that you owe, this is always due whenever the tax return is due. Now, in 2021 and 2020, we saw our tax seasons be extended. So let's say for 2020, the tax deadline was May 17th. The amount that you owe is due May 17th, whether you actually file your return on May 17th or not. This is very, very critical information because as soon as May 17th went by, if you had not paid your amount that you owe, penalties and interest would start accruing. This applies even if you filed an extension. A tax return extension is an extension to file, not an extension to pay. Now, last but not least is PTIN, number 15. You have to charge my head, not my heart, because I don't have number 15 here. But everybody should know what a PTIN is, especially if you pay a tax preparer. PTIN is an acronym and it stands for Preparer Tax Identification Number. If you are paying a preparer to do your return, They should not be using TurboTax, H&R Block Online, or any self-preparation software. They should be using a professional tax software, and at the bottom of your return, under the pay prepare information, there should be a number that starts, or a sequence of numbers that starts with the letter P. This preparer tax identification number is a must for paid preparers. Your preparer is issued this number by the IRS, and it says that they have the okay to be able to prepare tax returns. If your preparer is putting self-prepared on the bottom of your return, that means they are not taking any credit for doing this return before the IRS. Now, I want to let you know, the IRS requires us to put our PTINs at the bottom of a tax return. If your preparer is not doing this, or they don't have a PTIN, they are not authorized by the IRS to receive payment for doing your tax return. Now, that's all that I have for today, but if you found this video to be informational, please like it, subscribe if you're on YouTube, follow me if you're on Instagram or Facebook, and share the video. Because like I said, every taxpayer has the right to know what they're signing on their tax return. You can also connect with me at www.americasfavoriteea.com. Because I believe that all taxpayers have this right to know, I use that website to educate taxpayers on things that may cause them to stumble and have tax problems in the future. If you already have a tax problem and you have a bill that you can't pay or a notice that you don't know how to respond to, go to my business website, www.bowenstaxsolutions.com, and book a call so you can work with me directly. Now, if you knew all these terms, that's amazing. Kudos to you. But if you didn't, let me know down below which terms were new to you. Until next time, I'll see you guys in the next video.